Appreciate everybody coming and listening to us palaver today. It's a great talk so far. I hope I can meet the standards so far. I really want to talk about what we are trying to do, and we do it pretty well. But that is, in the United States, we're drilling, we've nearly completely turned over to drilling unconventional oil and gas. And when I say unconventional, and I should really say unconventional hydrocarbons, the concept of shale gas is a meaningless concept anymore. Shale is a meaningless concept. Really, what we're looking at is all the junk rock that we ignored for years and years that are in hydrocarbon basins and figuring out how to make them produce. The one factor that is constant, or there's two factors, low permeability porosity and gas, solution gas, or gas drive production. This is a very interesting issue because it makes gas a byproduct. So what's happened in the United States is we've moved completely in the last 3 years from drilling dry gas unconventionals to liquids unconventionals. I really wish that we were not such a literal industry. We called it fracking, short for hydraulic fracturing. And what were we thinking? It starts with an F, it ends with a consonant K sound. It's got to be pejorative to us. So it's, I really wish we had just called it something like walking or playing with puppies. Because who could really object to playing with puppies? But instead we gave it this name that it's just so hugely fun to basically remonstrate against. But this is the United States. What we talked about, we've had a couple of talks over here, and what you'll see in the last 10 years, 51,000 new wells drilled in the last 10 years for these unconventionals. And one thing that's unusual about the States is that there's 12,000 operators. In the last 2 years, there's been 2,000 active operators drilling these particular wells in here. And what you'll also see in here is we cut the rig count in late 2008, early 2009 in half. And you don't see any effect of it on this. It came entirely, the rig count problems came entirely at the expense of conventional hydrocarbons. Now, this is the United States' production, the oil production and the gas production, and you can see the steady decline that we had up until the mid-2000s, at which point, when we started doing this, we reversed. And well, we had a lot of discussions today. Dr. Helm had a great exposition with regards to what's happened in the United States. We've added 4.7 million barrels of oil equivalent per day over the last 10 years, and we're adding 1.1 million barrels of oil equivalent per day every year on a BTU basis. Well, this is kind of amazing because right now, from an energy point of view, we're really right at the peaks of what we achieved in 1972, 1973, and we don't have any kind of roofs on top of us. From an oil point of view, it looks like by about 2010, 2020, 2022, we're going to be able to achieve some sort of new peaks in oil. So this concept of peak oil and peak gas are certainly, if not fallacious, open to very steady critique based off of the results of what's happening over there. So the issues are, as he discussed, there's these reservoirs all over the world, and there's some peculiarities that have happened to allow the United States to be this great test bed, this great incubation. Because these 51,000 wells have drilled in there, these are 51,000 experiments. 51,000 experiments done by 2,000 various experimenters. A lot of ideas being tested, a lot of rocks being tested all the time. So how do you extract that information and figure out how it really works? Because some of the problems that we have in the world are, well, where's the water? Where's going to be the water to frack this from? Where are the frack crews? Where's the service capacity to go do any of this? Well, the idea that you have to go out there and maybe do a whole complete horizontal well with 9,000 feet offsets and 45 different stages and 7 million pounds, maybe you don't need to do that in order to test whether it's going to work or not. So that's what we looked at, is look at the 51,000 tests. Try to reduce these down so that you actually can go out there, maybe from a vertical well, maybe from a short horizontal, maybe from a light effort, the efforts that you have in country or available in country, to be able to determine what your recoverability can be with a scaled up operation. That's the goal of what we're doing. Just to put this into some sort of context, and the first part's only going to be really meaningful to anybody from the States, but that's because Willie Nelson sings a concert for farmers every year, and because we have private mineral ownership in the United States, which makes it easier to do deals, because people like checks in their pocket, the amount of money that the oil and gas industry shovels out to the small agriculture is equivalent to 75 farm aids picnics a day. I had this discussion with Willie Nelson's bassist. I live in Austin, Texas. He does too. We were drunk and having this discussion, and I said, you know, my industry is 75 times more important on a daily basis than what you do for farmers. And he took some exception to that. But in order to put it into some real perspective, I just wanted to compare it to Facebook's market cap. All that we do for small agriculture is the equivalent of the market cap of Facebook moving 3.5 cents. So it just goes to show that, you know, people knowing what you're going to do this weekend is far more important to the world economy than what we do every day to go out there and produce hydrocarbons. One of the things that I thought was pretty interesting in Dr. Helm's discussion was some details. In the last 6 months in the United States, there's been an offset. We've absorbed 4 billion cubic feet of gas a day into our electricity generation infrastructure in the last 6 months. And it's come completely at the expense of coal. That reduces down to 200,000 tons of CO2 reduction per day. Now, to put that into some sort of perspective, that's the equivalent of, over the last 6 months, removing 15 million automobiles from the highways of the United States. It's the equivalent of 5 million homes going completely solar. It's a huge impact. As he talked about this last year, the 1.7% decrease in carbon in the United States, we have no policy. This was free markets at work. There was not a single economist at work trying to craft some sort of policy that has had this magical effect. And that's very painful. That's very painful for economists. So how do we go out and we look at these things? Because in order to really look at how do you go out there and identify what works and what doesn't work, you first of all have to look at the geology and all these basins. What's happening right now is that production is coming from every kind of geology that you can imagine. As long as it's got some sort of source rock and shale in there, but the shale doesn't even really need to frack. As long as you can find something in there that can frack. So what we have to look at is we have to go out and identify it. We use a statistical process, and we go out there and we look at 50, 100 different geological inputs. And then we cross-correlate that with real results in all these basins. We look at it from a low effort, because usually in the earlier stages there's a lot of low effort, to the high efforts. We look to see if there's linear or nonlinear relationships, and if there's some really definable relationships, then all of a sudden you have this really interesting low effort methodology in which to determine how much can you get if you could actually bring in all the equipment into the country to go out and do what you're doing. So bring it into a financeable stage without actually having to make a $2 or $3 billion bet on the front end. Does that make sense? So once you've identified what the rock properties are, then you go out there and you start looking at the stimulations, because you have to kind of create a base level for the rocks. What will the rocks really produce? What's really driving production for the rocks? And then looking at these wellbore completion and stimulation efforts, the azimuth. We're told all these rules of thumb, and half of them are throwaways because we don't really know. We've not dealt with it from a big picture, a big data statistical point of view. And then, of course, the last part is solving for natural wellbore spacing. How many wellbores can you actually put per unit area before you actually start competing and start cannibalizing from the other wellbores. This has really yielded a lot of interesting things, because what this really has shown is that for the first time in the history of this business, there is such a thing as a marginal operator. That means that given the same rocks, you have companies that will go broke trying to produce those, and you have other companies that will make a fortune trying to produce those. Well, that throws a whole scary ball of twine with regards to how we do the oil business in the United States, because we've always just wanted the biggest bonus. We wanted the highest royalty. But for instance, in the Barnett Shale, in the dry gas portion of the Barnett Shale, the difference between the best operator per the type of rock and the worst was 70%. So that's not the difference between a 20% net revenue lease and or a royalty lease and a 25%. That's the difference between a 20% and a 60% lease. And I'm pretty sure they're not going to get a 60% lease. I mean, this isn't some of the countries here. I mean, this is just Oklahoma. So this is a big deal, and it's going to continue to be a big deal. That's why the companies that are investing in their operations, and they're also going out there and trying new things all the time, because a cookbook doesn't work throughout a play. Things change, rocks change, and as they change, you've got to change your operational capacities with those. So in this case right over here, for instance, this is the Eagleford. This is the geology of the Eagleford. So you have to extract geology from something, so it's seismic data, but the best thing is just petrophysical logs right over here. And what you'll see is that little green line over there is the top of the upper Eagleford. Then you have this little middle Eagleford carbonate. Then you have the lower Eagleford, and then the big carbonate underneath that is the Buddha. Well, interestingly enough, an Eagleford well has its heel in either the upper, the lower Austin Chalk. It has it in either the upper Eagleford, the lower Eagleford, or in the Buddha. All very, very different kinds of rocks. And the reality is the lower Buddha wells that have their heel in the lower Buddha that are toe up produce far better than any other kind of wells over there. So all these statistics you hear about wells and how they produce and all these other things, and what is the average economics? You know, I love seeing these charts where they go, well, this is $6 gas to be economic. Well, that's kind of like taking a look in this room right over here and saying, you know, on average, it's a pretty attractive crowd. There's a lot of end members on everything. Thank God the ugliest one's standing up here talking to you. But this comes out to grading. So how do you grade these areas? At this point, it becomes economic productivity, because we ended up having to grade for what produces, what maximizes liquids, what maximizes gas, and what maximizes economic productivity. And I will tell you, economic productivity changes all the time, because it's really a convolution of what's the value differential between oil and gas. And as you know right now, that difference is huge. The sad part about it is natural gas, nobody has drilled a well in the United States for a pure dry gas well in 6 months. And yet, gas production is going up in that straight line that it's always done, because at this point, gas is a byproduct. 30% of the natural gas in the Williston Basin right now in the Bakken play is being flared. That means it's got zero value. Similar amounts are being shut in or flared in Texas in the Eagleford play, because they don't have the pipeline capacity distribution to move it. We have too much. It's got zero value. Well, you know what's happened with that? It's solving another problem. And what you're going to see is not just that linking of oil and gas, or essentially that gas value and that oil value being different. You're seeing a linking now with water. Because for the first time in the United States, we have rational economics on water. Because nobody wants to basically subsidize the oil business for water. They charge us for it. And they charge us for the fresh water we put in there, and it's getting louder and louder. The public outcry against using subsidized water to frack a well when it could be put to far better use, basically watering golf courses. So in this case right over here, the oil and gas industry has to pay for basically going out and getting its fresh water. at some sort of market price. On the other hand, we produce water. It's that evil oil field brine that we've dealt with for 100 years that now everybody's very focused on. And what we're seeing right now is we have a variety of people that are going and pulling turbines up using free gas in the field to go out in there and take the oil field brines that they're getting paid to haul away and basically turning it into fresh water, selling the fresh water to the oil companies to go use for fracking, and then taking the minerals and the salts, and they're still trying to figure out what to do with that. I'm hoping it'll be some sort of, high-end food type thing, maybe sal de terre or something like that. But in this case right over here, we have all sorts of economic benefits coming out of this free gas. The other thing that's happening, believe it or not, is that oil and gas, there was a group out of Scotland that have come to the States, and they're using windmills, for God's sakes, and they're not using it to generate electricity because there's not enough money in electricity to do it. Their battery is fresh water. They're using the windmills to actually go out there and produce the electricity in the field to go out there and desalinate water, store the fresh water, which then they can store in tanks, therefore have some sort of storage capacity for that effort that's got a value over there. They can do this at about 4.5 cents. What they're claiming is 4.5 cents a gallon for water. Well, that's phenomenal. This membrane type work that's going on with regard to cleaning water is phenomenal too, because it's dropping the cost for taking the worst water on earth and turning it into fresh water from 40 cents down, all sorts of experiments down to 20 cents, down to 10 cents, perhaps down as low as 4.5 cents, 4.5 cents a gallon. Well, this is phenomenal. This is actually making fracking look more like the environmental miracle of all time. It reduces CO2 content, and it actually is creating the market responses to go out and create more fresh water from bad water in order to go do something evil and economic like putting it into a well to frack it to get more hydrocarbons. And yet we're creating all sorts of technologies to bring the cost down because for the first time we've actually had markets in place that are actually benefiting this kind of work. So there's a lot of things that are coming out of this that are going to be ancillary values to the problems that are being generated right now, at least the perceptive problems, because every big oil company, in fact, every oil company that's active in these unconventional plays is going on the predicate that it needs to be a closed system, that the water that they frack with, the water that they produce with, is water they're going to have to basically go out and recycle and use again because they do not have an expectation of there being ongoing access to fresh water. That is great for everybody in this room. These are the two maps right over here with just oil and gas. You can see how different they are. So in this case right over here, this is just an example from the Barnett dry gas. And this is one of the drivers. There was, typically when we look at 50 or 60 geological drivers for production, 2 or 3 become principal component drivers. And in the case of the Barnett, it was thickness of the Barnett from 0 to 400 feet. So it makes sense. How big is the can that you have? And the other one was, so it's pretty simple. You just go get an isopac thickness. And the second big driver was thermal maturity as a function of regional gas-oil ratio. How well is it cooked? Because you've got liquid loading, all the other issues that you have on that. So in order to try to determine what's the dry gas producibility, these are two things. One a fairly linear model, the other a little bit of a nonlinear model, but you combine them together, mapping out those thermal maturities, and then it gives you essentially what do you have in place. The thing that's becoming pretty interesting is our concept of how hydrocarbons in place are getting thrown out the window. We used to think that there was no permeability. We didn't think there was porosity in there to actually hold the kind of volumes we are. But in the the Wolfberry play in West Texas, which is just a big mixed intercalated shale, limestone, a little bit of sands in there, it's about 6,000 or 7,000 feet thick. It's completely charged, and it's all tight. It was tombstone. We drilled through it to go get at other stuff in the past. Now we're drilling through this, and it's going to end up being a multi-billion barrel play. But some of the latest work that's come out of there, as they've gone and done the detailed geochemistry on a zone-by-zone basis down there, is that they believe that there's 8 separate frac zones in that, 4 of which are going to produce about 60 or 70% of the hydrocarbons. But the amount of oil, not gas, but oil in place that they're looking at is 150 million barrels per square mile. Well, that's, what is that, 50 million barrels per square kilometer? And they think that they can, today in technology, recover 2 to 3 to 5%, and ideas on how to be able to get it 10 and 15 and 18%. And given that these fields are 10 miles wide and 200 miles long, this is an incredible resource. It's getting everybody's attention. It's making a lot of people very, very wealthy. We have Beverly Hillbillies all over again. I've met a few. So this just gave us this kind of graded methodology with regards to looking at what the values are. And then the idea of being able to go look at some of these over here and looking at over time. Things change over time as people try things. But in this case, you can see from these are production curves from the best grades, and you can see that A and B kind of, the best grades kind of are similar to one another, but then there's another grouping of B, C, and D, E, F, G, all the way down to the worst grading of production. The other thing that we've never thought about in this deal right over here is given that in the US we don't think about producing things for 50 years. We go do it, we drill a bunch of wells, and we sell it to somebody else. Well, we have a 100-year history in the oil and gas business of understanding of how good is casing integrity. When you go drill and you set a string and you perforate it, how long should it last? Well, you know, I think all of us feel comfortable that it should last 40, 50 years under normal conditions. But we have no idea with regards to laying in a string under lithostatic load, and we're perforating it in a cylindrical methodology all the way through there. So looking at some of these things, we start seeing that the first year failure rates are pretty high. And that concept of being able to build this out over time. And what you saw right over here, like in the Haynesville, we're up at 5% failure rate by the end of year 4, which means that in this case, if it follows the kind of curves that some of these others look at in the Haynesville, you might have 15% of your wells fail before it reaches some sort of economic lifetime. Well, that's a big enough impact to affect your overall value, because so much of the value is coming in late life. Now in the Barnett, we think it's going to be about 2.5%, 3%. It starts to flatten out over time, because I think what ends up happening is you really start to just equalize pressures all along those well bores after you start really producing from these various zones. And then of course, value, dollars, PUDs. This was back in the days when we had, which I don't think we'll ever see again, $15 an MCF gas, and it was so much fun to say that, $15 an MCF, gosh. And this was how much of there was a resource base that was a reserve base at this point. And it was a huge reserve base. And as you all know, it's not a linear reduction. You cut the price in half, you don't lose half of your resource, you lose 3/4 of your resource or more. And this is just what happens to that resource. This is the magically declining reserve base as you drop your price from $15 to $7 to $8 to $5 to $4, the sensitivity of all this. And here it is at $3, which is a little higher than what we had before. And of course, here it is at $2, which is a little closer. This is the Barnett Shale. So essentially, you had 30 TCF disappear. We look at things like max rates versus month, various cumes. We do a lot of EUR work with regards to looking at these. And what you're generally seeing in these plays, of course, is that there's some sort of, there's a relationship. So you're looking for things that'll let you judge how good a well is going to be early on. Does max rate make a sense? And in all these cases it does. And then we look, then you start looking at what is it under the averages and what is it under the best producers. And what you'll see is a real differential over there. And this sets up a world in which better producers can go buy the assets of not better producers for a huge discount. It changes the world entirely there. And then this is a scorpion plot. How many people here have ever heard of a scorpion plot? One person, good deal. This right over here is a volume. This is, if you think about it, this is an operator's collection of wells from best to worst, subtracting out the break-even well. You add them all together. Everything on the left-hand side is additive to investment. It means that you invested money, you're going to make a return on it. Everything that breaks over means that you lost money on those. If the whole thing drops over the edge and the far right-hand curve drops below zero, it means that you've been destroying dollars altogether. So in this case right over here, for a particular grade, you'll notice that there is one company out here that's broken even, and 2 or 3 companies, in fact several companies that have made a lot of money being able to do it. They don't drill bad wells, and that first company drills a lot of bad wells. This is a creaming curve, which I'm sure everybody else is a lot more knowledgeable about, but looking at seeing if they're getting better or not. These are things that are simple to do. You look to see if a company is figuring out better practices. And that shows up as a change in the slope, a positive change in the slope. A negative change in the slope means that they're just doing things by rote, or they're probably starting to infill too much. The thing that's important to see here is the worst play on this, the worst guy over here. This is a creaming curve, so the X deal is number of wells. The y-axis is the amount of production it's made over a certain period of time. You'll see the difference between the best and the worst is about 3 to 1. That's huge. Lateral length impact on productivity. Lateral lengths make a lot of sense the better the rocks are. The more average the rocks are, the less they can all be quantified. And when it can be quantified, you can look to see what is your price optimization, what is your cost optimization for production. On your poor rocks, it doesn't really make a difference how far out your lateral goes. It just is not adding that much more. The other thing that falls out of this particular graph right over here is the heel always produces more per foot. That first 1,000 feet of lateral always produces more per foot than all the subsequent every subsequent foot that you drill beyond that. In every case, we've seen this in every different play. And in the best rocks, the heel will produce at, say, 100%, the subsequent 1,000 feet will produce at 60% fairly linearly. The worst rocks, maybe 10% fairly linearly. So what does this tell you? Well, it tells you that perhaps going out all the time at 9,000-foot laterals isn't the best idea. Maybe sometimes it makes sense to drill 1,000-foot laterals. Maybe it makes sense to do more short multilaterals than it does to do big, long well bores in there, especially given the grades of the rocks that you have. That's a huge impact. Simul-fracs. How many people here have heard of simul-fracs? Zipper fracs. These are wells that they drill them horizontally to one another, and then you go out there and you frac them all at the same time. So you're kind of trying to equalize the whole pressure regime. A zipper frac is doing the same thing, except you're drilling one on the upper part of the horizon and the other on the lower part of the horizon, and you're just zippering it. And you're fracking them all together. The idea being that this doesn't add any cost, because you're going to have to frac them all anyway. As long as you've got the equipment in there to go frac them all at the same time, does it work? Well, EOG was the first to try this, and what we really determined over here was, yeah, it gave you 15% more production in this play. So these were kind of these interesting things that pop out by looking at all these experiments over here, because this is no added cost, great added benefit. I guarantee you 15% across the board is a great one. And then it comes out to the operator ranking. And notice in this case right over here, this is an older one right over here, but this was for the dry gas in the Barnett Shale, and you can see EOG was the best operator, an adjusted ranking of 100%. And you can see the worst ones down over here were at 25 and 40% of what EOG would have extracted from that same grade of rocks. This is a fairly robust statistical model. And you'll also notice that the best ones, Chesapeake and EOG, were producing typically 20% better, 20% more than just the good ones, the ones that were considered to be very good at this. Well, this is a big differential. I guarantee you this is a much bigger differential than your cost of capital, which everybody makes decisions off of. And it's completely unrecognized, which means it lends you into all sorts of opportunities with regards to under-optimized acreage. So by taking all these tails we're doing in the States and starting comparing these to basins all over the rest of the world to try to understand, here's what we think should work, but here are the low-cost tests that you need to go do in order to basically fit it into one of the basin models. That way, the world can take advantage of the fact that there's 12,000 operators doing 50,000 experiments and be able to consolidate all that without having to basically have 12,000 operators and 50,000 experiments before it starts to get right. If we were going to do anything differently in the States today, what we would have probably said is we should have actually mandated that we do water tests. We should have done the aquifer baseline studies so that we're not having to go out and deal with gas land surveys again. Because we let the dog, just as you said, the barn door was open. And we let somebody else go frame the argument. No matter what science, because we are completely validated by the science, but nobody trusts science. The only thing they trust is if you can go do it beforehand, show what the issues are beforehand, before you do anything, and then have that to refer to backwards. And take responsibility for the damages that you create. Thank you very much.